Welcome back. Today we're doing a structural breakdown of the COMEX silver futures delivery mechanism, specifically looking at how the March 2026 contract cycle works, what the registered inventory data tells us, and what the sequence of key dates between now and the end of February actually means for market participants. This is an educational walkthrough. We're not making price predictions. We're explaining the documented mechanics of a publicly observable system using data from CME Group's own warehouse reports and open interest filings. Let's start with the basics. A COMEX silver futures contract is a standardized agreement to deliver or receive 5,000 troy ounces of silver by a specified date. At current prices, one contract represents approximately $420,000 worth of metal. The key distinction in this market is between two categories of short sellers. A covered short holds physical silver already sitting in a COMEX approved warehouse, cataloged and legally designated as deliverable. If assigned a delivery notice, they can fulfill the obligation immediately. A naked short has sold a delivery promise without currently holding the underlying metal. Under normal market conditions, this works because most contracts are closed or rolled before the delivery mechanism activates. Liquidity is typically sufficient for the short seller to either close the position at a profit or source metal from another party before the deadline arrives. The physical silver that can legally be used to settle a futures contract is called registered silver. It sits in CME-approved depositories and is the universe of metal the delivery system can draw on. The ratio between registered silver available and total open contracts is the core structural variable in any delivery month analysis. Let's look at where that ratio stands right now. As of mid-February 2026, the March silver contract carried approximately 47,847 open contracts. At 5,000 ounces each, that's a theoretical delivery obligation of around 239 million ounces. On the supply side, COMEX registered silver the deliverable inventory stood at approximately 88 million ounces. That's a ratio of roughly 2.7 to 1. For every ounce of physically deliverable silver in the COMEX system, there are nearly 3 ounces worth of open contracts. Now this imbalance is structurally normal at the start of a delivery month. Open interest is expected to decline sharply as the deadline approaches, because the majority of futures participants are not seeking physical delivery. They're using the contract for price exposure and will close or roll their positions before the delivery mechanism activates. What makes the current cycle worth analyzing closely is the inventory trend line. In October 2025, COMEX registered silver stood at approximately 170 million ounces. By mid-February 2026, that figure had fallen to approximately 88 million, roughly half in 5 months. This wasn't a single withdrawal event. It has been a sustained, month-on-month reduction that has not reversed. Additionally, in the 4 weeks immediately preceding February 20th, approximately 90 million ounces left the combined COMEX warehouse system, a rate faster than the prior monthly average. BlackRock's SLV ETF also drew down holdings during this period, with approximately 45 million ounces removed, including roughly 12 million from the COMEX eligible pool. Eligible silver is not the same as registered silver. It hasn't been formally certified for delivery, but it represents the pool from which registered inventory is typically replenished. A reduction in eligible holdings narrows the potential buffer. If the registered inventory trend continues at its current pace, projections place it at approximately 80 million ounces by the first delivery date in early March. The CME Group, which operates the COMEX, has a standard mechanism for managing delivery pressure, margin requirements. When the exchange raises margin, it increases the deposit participants must post to hold a futures position. Participants who cannot afford the higher deposit are forced to close. Fewer open contracts means reduced delivery demand, which makes the math more manageable. Between October 2025 and February 2026, the CME raised silver margin requirements 6 times. The requirement moved from $22,000 per contract to approximately $74,000, more than triple in 4 months. Despite 6 separate increases, the open interest as of mid-February still sat at 239 million ounces. The participants who remain are those who absorbed every one of those margin calls and held their positions anyway. From a structural standpoint, this means the filtering effect of margin hikes has already run its course on the current open interest. What remains is, by definition, the most capitalized and committed segment of the participant pool. There are 3 dates in the March contract calendar that define how this delivery cycle resolves. Thursday, February 26th, first position date. This is the last day on which a long holder can exit the March contract without being treated as a willing delivery recipient. After close of business on Thursday, clearing firms require that any remaining long position belong only to participants with the capital and infrastructure to accept physical delivery. Any speculative long that has not exited by Thursday is treated by the exchange as electing to receive metal. Friday, February 27th, first notice day. This is the date the delivery mechanism formally activates. Beginning on this date, a short seller can issue a notice of intent to deliver. Once that notice is issued and assigned by the exchange to a long, the long is obligated to accept. They cannot negotiate timing or terms. The key asymmetry here is that it is the short, not the long, who controls the timing of the notice. A long position holder on Friday morning has surrendered timing control, and any short seller who does not hold the physical silver to deliver must either have sourced that metal externally or close the contract at prevailing market prices. There is no third option. Monday, March 2nd, first delivery date. This is the earliest date physical silver can actually change hands. The short transfers a vault warrant representing metal held in a CME depository. The long wires the full cash value. Ownership transfers. If the long is an industrial end user, that metal will typically be withdrawn from the warehouse in subsequent weeks, further reducing the registered inventory heading into the next delivery cycle. One additional structural point worth noting: the May 2026 contract has already surpassed March in total open interest, currently carrying approximately 56,000 open contracts versus March's 47,847. This means the next major delivery month is already larger than the current one before March has resolved. If registered inventory is drawn down through the March delivery process, the May delivery window opens against a structurally weaker warehouse position. For broader context, global silver consumption has exceeded combined mining and recycling output for 5 consecutive years. The current inventory dynamics at the exchange level are in part a visible expression of a multi-year structural supply gap becoming apparent at the contract settlement mechanism. So to summarize, the COMEX delivery system is a well-documented, publicly observable mechanism with specific calendar dates and inventory thresholds. The data points to watch this week are the registered inventory figure, the pace of open interest decline heading into Thursday, any CME margin or rule announcements, and the price relationship between silver and gold as the first notice date approaches. None of this is financial advice. This is a structural explanation of how the futures delivery mechanism works and what the current data shows. If you found this breakdown useful, subscribe for ongoing analysis as the delivery cycle progresses. The data updates daily, and the most relevant figures will land between now and Friday. We'll see you in the next one.